When a major city decides to replace its underground water mains,
Uh-huh.
on the surface, it is just total chaos. Traffic is backed up. You've got jackhammers blaring. And, well, everyone is complaining about the mess.
Yeah, it's always a complete nightmare.
Right. But underneath all that noise, there is this permanent, massive structural upgrade actually happening. Welcome to the deep dive.
Today, we are looking at a stack of sources from NYDIG market reports to a really fascinating New York legal filing.
And our mission here is to help you see past the short-term volatility on the surface. We really want to help you understand the massive structural and, frankly, legal integration quietly happening behind the scenes.
Exactly. And that surface chaos has been, especially loud lately for anyone watching the charts. Just look at the recent 24/7 market whipsaw.
Oh, yeah. I mean, the price hit an intraday high of $65,518, and that was driven by cooling U.S. inflation data.
Right. Sounds like good news. Yeah, but then almost overnight, it just crashed down to $63,830. And the trigger for that drop wasn't even domestic at all. It was a South Korean credit crisis involving legacy tech giants, like Samsung and SK Hynix.
Okay, wait, hold on. I am a bit confused here.
Mhm.
Because if this is supposed to be a decentralized global asset, why does a localized corporate credit squeeze in Asia instantly crash the price across the board?
Well, it's because traditional finance and crypto now share the exact same plumbing. It's a textbook case of liquidity contagion.
Meaning what, exactly?
So when traditional financial markets face a credit squeeze, like what just happened in South Korea, heavily leveraged retail traders get margin called on their traditional stocks.
Oh, so they have to scramble to cover those positions.
Right. In this specific case, trading volume on the Upbit platform spiked over 1,300% in a single day.
Wow.
Yeah, because over 1 million credit accounts faced forced liquidations. They have to sell whatever is highly liquid just to cover their traditional margins, which, absolutely hammers the digital order books.
Which means retail investors are out there panicking over these daily liquidations, and they are completely missing the bigger cyclical picture.
They really are. I mean, the analysts at NYDIG point out that this current chop is actually a classic supply-driven slump.
Okay.
When you look at historical cyclical supply mechanics, the patterns project a potential cycle low of maybe $38,000 to $39,000 by October 2026. While retail focuses on the daily noise, legacy institutions are quietly locking in the underlying foundation.
Right, like the Depository Trust Clearing Corporation, the DTCC, they're officially moving past sandbox testing environments.
Yeah, they are.
And for context, a sandbox is basically just a safe, simulated environment where financial institutions play with fake money to test new tech.
Exactly. But they're out of the sandbox now. The DTCC is processing live, real-world, tokenized asset trades on blockchain rails. I mean, this includes actual U.S. Treasury deliveries and collateral pledges.
That is huge.
It is. Combine that with Japan's new legislation, which just reclassified the asset as a standard financial instrument.
Oh, wow. So what does that actually change for them?
Well, by doing that, Japan basically allowed legacy asset managers to legally put this into retirement portfolios without jumping through regulatory loopholes. It bridges the gap between digital assets and the traditional 401k.
Wait, so if the DTCC is settling tokenized treasuries and Japan is normalizing it for retirement, that means the original cypherpunk dream is basically dead, right?
I mean, pretty much, yeah.
The asset is no longer trying to replace Wall Street. It is just becoming Wall Street's newest back-end software.
It is being hardwired directly into the legacy engine. But as this digital framework rapidly integrates, it is forcefully colliding with physical constraints. The mining sector is a perfect example of this friction.
Right, because of the whole AI boom.
Exactly. AI data centers are currently facing $24 billion in delays across the U.S., mostly due to public protests and power grid limitations. Because of this massive physical bottleneck, Bitcoin miners are pivoting.
They are doing what you called infrastructure arbitrage.
Right.
Basically, miners are realizing that right now, renting out their massive power supplies and land rights to AI companies is actually more profitable than using that power to mine coins.
They hold the most valuable physical assets in the current market, which is turnkey power and land. And they are leveraging them to service high-performance computing.
So traditional finance is moving in, and miners are physically pivoting to AI. But building physical infrastructure is only half the battle of integration.
Oh, definitely.
The other half is surviving the legacy legal system. And that system is currently trying to seize 39,000 dormant wallets in New York through the no-a-do lawsuit.
The stakes here are just staggering. You have anonymous plaintiffs trying to claim 3.8 million dormant coins. That is valued at around $293 billion.
Billion with a B. That is insane.
Yeah, and they're claiming it as abandoned property under state lost and found statutes. The reason you need to pay attention to this is the precedent it sets.
Right, what happens if they actually win?
If the plaintiffs win, it forces long-term holders to execute artificial transactions simply to prove to the state that they are still alive.
Think about how crazy that is. The entire concept of cold storage is designed so you can memorize a 12-word seed phrase, bury it in your backyard, and securely leave alone for 50 years.
Exactly.
But New York's lost and found laws are essentially saying, hey, if you don't digitally wave your hand every few years to prove you're alive, we're taking it.
Yeah.
It fundamentally destroys the asset's utility as a passive store of value.
It really does. And when you connect all these pieces, you realize the daily price chart is just a distraction. The real story for you to watch is this profound legal, corporate, and physical restructuring happening right beneath our feet.
The surface might look chaotic, but the permanent infrastructure is being laid down. Which leaves you with this final question to ponder. If governments and anonymous plaintiffs can successfully exploit analog lost and found laws to seize billions in digital wealth, does true, unseizable digital ownership actually exist?